Did you know that 90% of individual investors lose money in the stock market? It sounds shocking, but it's true. Most people get caught up in the wrong strategies and end up falling short of their wealth goals. You've probably heard about people striking it rich, but what about the other side of the story? The truth is, many investors are unknowingly sabotaging their own success. In this video, we're diving into the 6 biggest mistakes that could stop you from becoming rich. From panic selling to chasing hot tips, these common traps can derail your investing journey before it even starts. Want to avoid losing your hard-earned money? Keep watching, because we'll show you exactly what to avoid and how to build wealth the right way. Stay tuned. Chapter 1. Chasing hot tips, the investor's shortcut to disaster. Let's face it, we've all been tempted by that hot stock tip from a friend or a social media post. It seems like everyone knows someone who got rich quick, but that's rarely the case. Chasing tips often leads to disaster because these suggestions rarely come from experts. In fact, according to a 2016 study from the University of California, people who follow stock tips tend to underperform the market by nearly 6%. Think about that. When you chase trends, you're really betting against the fundamentals. Warren Buffett himself says, "The stock market is a device for transferring money from the impatient to the patient." This is why you need to avoid impulsive decisions based on someone else's opinion. Instead, focus on understanding the business, its value, and its future growth. Successful value investors, like Buffett, spend hours reading financial reports, not scanning Twitter for tips. By investing in companies with strong fundamentals, you're setting yourself up for long-term success. Don't be that person who jumps into the next hot stock only to find out it's a fad. Remember, if it sounds too good to be true, it probably is. Chapter 2. The myth of timing the market. Don't let FOMO fool you. Trying to time the market is like chasing after a moving target. Most people fail, and it costs them. A study by Dalbar found that the average investor underperforms the S&P 500 by nearly 4% annually, mostly because they're trying to buy low and sell high, but without the tools to predict market movements. This constant guessing game often leads to poor choices. Buffett often says, "Our favorite holding period is forever." When you focus on quality companies, you don't have to worry about timing. Investors who try to jump in and out of stocks are more likely to get caught in the volatility, missing out on the real growth. In fact, staying invested through market swings is one of the simplest ways to build wealth. Over the past 90 years, the S&P 500 has returned an average of 9.8% annually, and if you were to miss just the 10 best performing days each decade, your return would drop by 50%. So, the next time you feel the pressure of timing the market, or fear missing out on a hot stock, remember that patience is your friend in value investing. Chapter 3. Ignoring fundamentals. Why gut feelings won't make you rich. Investing based on your gut is a recipe for failure. Gut feelings may be helpful in many areas of life, but not in investing. Companies rise and fall for reasons that can be measured: earnings, growth potential, and competition. Yet, many investors rely on feelings rather than facts. According to a 2020 study by the CFA Institute, investors who focused on fundamentals outperformed those who based decisions on gut feelings by over 50%. When you ignore fundamentals, you open the door to speculation, which can lead to poor decisions. Value investors, on the other hand, dig deep into financial statements and assess a company's true value. They focus on key metrics like price-to-earnings ratios, earnings growth, and debt levels. For instance, when investing in Coca-Cola, Buffett looked beyond its brand recognition and considered its consistent cash flow and dominant position in the market. That's what made it a great long-term investment. Just remember, trusting your gut might feel good, but relying on data and fundamentals is what leads to real wealth. Don't forget to subscribe. This video is packed with tips that can change your investment strategy for the better. Chapter 4. Panic selling. The silent killer of your portfolio. Panic selling during a market crash is a trap that can destroy your portfolio. It's easy to get swept up in fear when prices are falling, but this reaction often locks in your losses. According to research by Morningstar, investors who sold their stocks during major market crashes missed out on the recovery that follows. In fact, if you had sold your stocks during the 2008 crash, you would have missed out on a nearly 400% return in the next decade. The key is to resist emotional reactions. Instead, remind yourself that market fluctuations are normal. Warren Buffett famously said, "Be fearful when others are greedy and greedy when others are fearful." This approach allows value investors to buy when prices are low and hold onto their positions until the market recovers. Staying calm during volatile periods lets you capture long-term growth, while panic selling ensures that you lock in short-term losses. By sticking to your strategy and focusing on the long-term value of your investments, you're much more likely to come out ahead. Chapter 5. Following the crowd. The herd mentality that leads to ruin. When everyone else is doing something, it's easy to follow along. But in investing, following the herd is often a dangerous move. The crowd typically buys into hype, especially during a market bubble. History shows that herd mentality leads to poor investment choices. Take the dot-com bubble of 2000. Many investors piled into tech stocks without considering their long-term viability. By 2002, the Nasdaq had lost nearly 80% of its value. Value investors, however, go against the crowd. They focus on finding companies that are undervalued but have strong long-term prospects. They are willing to invest in industries or stocks that the market may be overlooking. This contrarian approach is often what leads to success. A great example is Buffett's investment in American Express during the 1960s when the company was struggling. Most people avoided it, but Buffett saw its value and invested. Next time you feel the urge to follow the crowd, remember that value investing thrives on independent thought and a long-term perspective. Chapter 6. Overlooking the power of patience. Why slow and steady wins the race. In today's fast-paced world, patience is a rare but powerful trait for an investor. The stock market rewards those who are willing to wait for the right moment, not the ones who are constantly chasing quick returns. Research by Vanguard shows that long-term investors who hold their stocks for 10 years or more earn nearly double the return of short-term traders. Buffett's investing philosophy is a prime example of this. His most famous quote, "Our favorite holding period is forever," underscores the importance of patience in value investing. He's built immense wealth by buying great businesses and holding them for decades, allowing the power of compounding to work its magic. Value investing is about waiting for your investments to grow, not forcing them to do so. The longer you hold onto a great company, the more likely it is to increase in value, especially when reinvesting dividends. Patience may seem boring compared to day trading, but it's the key to sustainable wealth building over time. So, remember, slow and steady really does win the race when it comes to value investing. If you found these tips helpful, don't forget to hit that subscribe button. Keep up with more strategies to build lasting wealth.